Hey there, everyone. Happy Thursday, January 8th, 2026. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you not from a rainy Redmond, Washington, but from a beautifully sunny Tampa, Florida. Doing this a little bit later than normal here today. Thanks for being appreciating your flexibility as I work around the CMT Midwinter Retreat. It's been a fantastic event so far. This was the first full day of the event. We have the second full day tomorrow. I was able to speak earlier today, a presentation called The Mindless Investor and the Mindful Investor, talking about the paradigm of how so many investors go through their investing life mindless, right? Not paying attention to the right things, not having good discipline, not having good structure to their process, lacking consistency, but also flexibility. And we talk about the mindful investor, addressing some of those issues using some of the tools that we talk about on the show, technical analysis and behavioral finance. I was able to meet a number of viewers there in attendance, and it's been awesome to meet some of you guys. Thanks so much for saying hello. And I hope all of you, wherever you're tuning in from, are doing well. With everything here going on. As we get to the markets here in a moment, we're going to talk about this, kind of choppy sideways day, to be honest with you. It's a bit of a nothing burger in terms of the overall market direction. But as we look at some of the themes surrounding that, we'll see some moves in things like energy. We'll see some moves in things like technology. You'll see the heat map has a very compelling complexion today with some interesting takeaways I think we should be aware of. It's funny, though, as I get to, before we get to the charts here, this is one of the reasons I was late. I wanted to check out Cathie Wood's presentation. She was interviewed by Eric Cass, one of the CMT members here in Tampa. It was fascinating. It was, between all of us, it was a fire hose of bullishness. It was optimism about AI, optimism about GDP growth, optimism about AI companies' ability to monetize what they're doing, the power of emerging technologies and their opportunities to transform our economy for decades to come. So I am pretty full of the bull case right about now. I will. You'll probably get a little more tempered view as I personally look at the charts here. But listen, and what's funny, even though I agreed with some of what Cathie was sharing, I did not agree with all of it. I would say she has a much more optimistic view about the amount of money that AI companies are spending right about now. Way more belief that AI companies are generating a ton of earnings today, which was what she was mentioning, and just the idea that the innovative technology in a lot of ways is enough, and talking about all the long-term opportunities there. It's all going to be good. There's not a lot of downside, right? Asked about the downside of AI. The dark side of AI, it's not going to be that bad. There's plenty of checks and balances in place. I hope that's true. So anyways, I was taught to look at everything with a critical eye. So as usual, I sort of listened to what she was saying and then sort of thought critically about what I agreed with and what I didn't. Honestly, I think whether or not you agree with someone like Cathie Wood or someone like Bob Prechter, who I've talked to many, many times, who has a long-term bear case for stocks, I think that's so helpful to hear people out, especially if it's a point of view that you disagree with. I think in this day and age, we don't have enough of that. We don't have enough of respectful hearing out of differing points of view and thinking critically but respectfully about what you agree with and what you don't. I hope we can get back to more of that. We'll see. That's my optimism for humanity as we're able to do so. All right, soapbox done. Let's talk about the markets here. S&P flat for the day. The S&P finished 0.01% off of Wednesday's close. That's 69.21 and change, about a half a dollar higher. So still well below that 7,000 mark, but not by much, right? So really more of a choppy sideways day. We ended where we started for the most part. The Dow was up a little bit more, about 0.6%. The NASDAQ down. So Dow over NASDAQ, S&P basically flat in the middle. Small caps, the big winner here, finishing up 1.4%. So look at the difference between the S&P flat, the NASDAQ basically opening a lot lower in the first 15 minutes and then remaining down there. And then small caps just kind of lights out positive. So small caps, again, more and more you're starting to see some of these days where small caps start to look kind of impressive. Is that a sustainable move that's just beginning? I think that remains to be seen, but certainly worth pointing out we're seeing those early signs here. Volatility popping up a bit, kind of a noisy day for the VIX, but not much, not too far from where we were yesterday. We're right around 15 and a half. So we're still in a low volatility environment. Rates generally moved higher here, particularly the longer out in the curve. So the 10-year point up to 418. The long bond is around 485. So rates starting to push just a little bit higher here. We've had that normalization of the yield curve. That steepening of the yield curve here has been a trend in recent months. That's sort of continuing a bit today. The TLT, which is a bond ETF, down slightly. The dollar ETF, the UUP, up slightly. Commodities generally pretty decent today, although it was really more mixed when you look at it. Energy, the big winner with the USO, which is a crude oil ETF, up 4.1%. The natural gas ETF, UNG, was down 4.3%. Silver down 1.8%. Gold up 0.6%. So truly kind of a mixed bag, even within energy, mixed, within precious metals, mixed. So again, from equities through commodities, I would say this is a pretty choppy, sloppy, sideways day more than anything. Even Bitcoin's pretty much right where it was about 24 hours ago, currently around 91,240. That's just down slightly from where we were a day ago. Ethereum prices a little bit worse, down 1.5%. Most of the top 10 cryptocurrencies on the stock charts platform in the red today. In terms of sector movements, though, not a bad day. 9 out of the 11 S&P sectors finished in the green, including some big moves higher in energy. The XLE was up 3.2%. Your second from the top, consumer staples. When was the last show where we talked about the XLP being in the top 3? I'll tell you the answer, very rarely. XLP was up 2.4% today. Food products names I was looking at as I was scanning through a bunch of charts earlier today, popping up on my radar. Materials, number 3, up 1.8%. On the downside, only 2 sectors lower. Technology down 1.6%. Some of those big tech names like Apple, like Microsoft, some of the semiconductor names still not really looking particularly strong. Not horrible, right? They're not bad charts, but they're not great charts anymore. They're kind of good to okay, I would say. Healthcare also down about 1% today. Looking at the breadth, kind of depends on where you look, but generally pretty positive. On the New York Stock Exchange, 69% higher to 28% lower. On the S&P, 71% up, 29% down. On the small cap index, about a 4-to-1 ratio. That's your best breadth, 78% up to 21% down. So again, small over large was kind of the story today. Value over growth, generally the story today. With sectors like energy, consumer staples, which is a little more defensive, but definitely more value-oriented, finishing at the top of the list. Home builder is kind of a surprise one at the top, and I grabbed the chart, I think, of the XHB to share with you in a little bit. Looking at the Magnificent Seven and Friends, you can see Amazon was up 2%. Amazon had been an underwhelming chart for a while, obviously one of the big weights in the consumer discretionary sector. This week has been pretty positive, right? Tuesday, Wednesday, Thursday, all drifting a bit higher, up another 2% today. That's encouraging. Alphabet up 1.1%. Tesla, not a great chart, but still up about 1% today. On the downside, you got some pain in the technology sector, particularly the semiconductors on this list. Broadcom down over 3%, NVIDIA down over 2%, Apple and Microsoft down slightly from yesterday. All right, we'll go to the market carpet as we go there. As a reminder, welcoming your questions as always. We'll be back in Redmond, Washington next week. We're flying back early Saturday morning and planning a normal publishing schedule next week. Again, appreciate your patience this week. It's ended up being a travel week, so I'm getting to the show and everything when I can. But it's a pleasure to put this out on YouTube every day. I appreciate you watching. I appreciate you sharing it with someone else that you think would benefit from a daily discussion, quick recap of market conditions, and trying to connect the noisy day-to-day movements with some of the longer-term trends that I think are more important for investors, for position traders, but also understanding some of those swings as well. I think it's important to recognize them. Please take a moment and drop a question below. Any questions that come up during the show, I'd welcome your question. Tomorrow on Friday, we're planning an all mailbag episode. Not exactly certain when I'll get to that. It'll probably be pretty late in the evening, given the schedule during the day. I'm actually hosting a panel tomorrow afternoon with 3 chief investment officers from around the U.S. Coming in to talk about how they use technical analysis in their investment process. So as soon as I can, after the wrap of day 2 of the conference, I'll get back to the room and share some charts with you. Having said that, upper left corner, that's the red, right? Technology. While the breadth was good today, while the sector breadth, right? 9 out of the 11 sectors were up. Sector breadth was good today. The performance in a couple specific sectors, and I'm looking at you, technology and healthcare, underwhelming. And I think that's the issue a lot of people are going to have with the day like today. Nvidia, Broadcom, Oracle, Palantir, Micron. So I mean, if you go, let's see, the top 1, 2, 3, 4, 5, 6, 7, 8, 9. You have to go to the 10th stock, IBM, for a stock that wasn't down today. So I would say the breadth in technology, in particularly, not good. And some of the semiconductor names, the semiconductor groups, the ETF SMH has done pretty well here recently, outperforming in a decent way to kick off the year. But today, kind of giving back some of those recent gains. Those charts are still good, right? The chart of Micron is still pretty awesome. Made a new all-time high yesterday, so let's not get too nervous too quickly. But this was definitely a give back day, giving back some of those previous gains. Now, Apple and Microsoft have been struggling here for the last 6 weeks. Apple, getting to its 200-day moving average, breaking down. Microsoft still holding support just below 475, but very, very close to breaking down there. And those are obviously two of the three big names to watch. And NVIDIA has been languishing here, right? It certainly gives the appearance of sort of a big, what we call a complex head and shoulders top. But you need a breakdown below the neckline, which we have not done yet. It's down around 170 to 175 would be that level of support. So let's look elsewhere in the heat map. In terms of sectors doing quite well, I would say the consumer sectors obviously jump off the page to me. Consumer discretionary with charts like Home Depot, potentially making a new swing high here. I think HD's testing resistance on a closing basis around 360. I think that's an important one to watch. You have charts like TJX, the old TJ Maxx ticker, up another 2.7%, making a new all-time high today. But also consumer staples, big box retailers like Costco, Coke, and some of them. And again, these are not great charts, right? If you're looking for, impressive charts, these are not it. But they're having a pretty good update today. So again, it's like technology with some great charts pulling back, consumer staples with some underwhelming charts starting to break down. I think with something like Philip Morris, good chart to review because, what would it take for a chart like this to start to look good again? And I think that's what you want to think about when you have a chart that's going down, like Philip Morris was doing from June really to Halloween, right, to the end of October of last year. What made it an underwhelming chart, a downtrend chart? Below downward sloping 50-day moving average is one. Failing at the 50-day moving average on all these little short-term rallies. Lower lows and lower highs, those are all the definition of a downtrend. Momentum pretty weak with the RSI, rarely getting much above 50 and not getting much above 60, even on those bounces higher. And in that sort of situation, underperforming because the major indexes were going higher. Now, pretty much everything that I just said is no longer true about the chart of Philip Morris. From Halloween to where we're at now in early January, the chart's now making higher highs and higher lows. The momentum has switched from being below 60 to actually being above 40. It's actually drifted higher quite a bit. It's not really outperforming too much, but it is technically outperforming since Halloween, right? With that bit of that uptrend. Now, what would it take to get really optimistic? We're right at the 200-day moving average. We tested that right around the holidays at the end of the year. We break above that 160 to 162 level, would clear the 200-day, would clear the December swing high. At that point, we're making higher highs and higher lows. At that point, the momentum's probably continuing to improve. And at that point, the stock is most likely outperforming. Those are the things that I think would change that would allow you to be pretty confident about that being a new confirmed uptrend. Not quite there, but very, very close. But certainly no longer in a consistent downtrend phase. And again, I think that's important. A lot of times when people see a chart going down, if you're more of a trend follower like I am, you just say, well, that's a downtrend, and you forget about it. What you always want to remember is the initial rotation can be very powerful. So you have to have a regular review of these charts to look for those downtrends that are no longer downtrends. Of course, we'll do our best to highlight those here on the show, but I hope you have a part of your own process that is meant to capture those. Finally, I want to highlight within energy, where we've got charts like Exxon and Chevron, which both spiked higher after last weekend and the events surrounding Venezuela. But those aren't the charts that are most impressive to me. A chart like Halliburton up almost 6% today, again, pretty impressive. That's one that's actually making new highs. Phillips 66, PSX, very close to making a new all-time high today. Valero Energy up 4%, making a new all-time high. So all energy stocks are not created equal right now. And I would encourage you to not just think of something like energy as a single stock, but it's a group of very different businesses, from the upstream, the downstream, the midstream, the pipeline companies, right? I mean, they're all different sort of businesses and have different relationships to crude oil in a lot of ways as well. So some of those that I just mentioned, certainly some of the more impressive charts. All right, we'll continue on looking at the chart review. As a reminder, please drop your questions in the chat when you have a moment. I would love to see them in our comments section on our YouTube channel. We're planning an all mailbag episode, and I look forward to addressing one of your questions on the show for everyone's benefit. Before we wrap the show today, let's look at some charts together, updating you on our traffic light approach here. If you look at the daily chart of the S&P 500, again, I think a traffic light, it's not all the time when I think this makes sense, but particularly when you've had a big run and then you have that big initial pullback, and then you spend some time in that range, I think it's really helpful to look at the structure and think about what you would need to see to think of this as a pretty bullish chart, what you would need to see to think of it as a pretty bearish chart. And then that gives you a sense of what the yellow light middle ground is like. For me, 6,900 and up is pretty good. That's where we've been here so far this week. The big move was on Tuesday's session as we made a new all-time high. We did make an intraday high yesterday, but we did close down at the lows of the day, and today a bit of a lower low. So we're kind of testing the difference between the green and the yellow areas here. A trend line taking the major low in November and December lines up pretty well with the first trading day of the year, just a slightly below today's low. So if you're looking for some sort of trigger that might tell you the short-term rally from Thanksgiving might be over, I think a breakdown of that trend line would be something to watch. For me, though, I would say anything in this area is still kind of noise. It's chop. A break below 65.50, that's the red light move for me. That's where I would start to get to think a lot more defensively. Note how the momentum has not been particularly good in the last 8 to 10 weeks, right? The last time the RSI was anywhere near overbought was on this all-time high at the end of October. So that's when I've talked about, I think technically the all-time high was yesterday. I would say the all-time high was really at the end of October. I see these as failed attempts to get above that level. For now, we'll see if this continues. But the fact that the momentum is still pretty low tells you this isn't much of an impulse move. This is more of a bounce retest. And we'll see if the momentum improves on a breakout. That would obviously be pretty encouraging. With 9 out of the 11 S&P sectors higher, with a lot of stocks up, more stocks up than down on the major indexes and exchanges, that means breadth generally is doing just fine. And we can see that here on the charts of stocks in the S&P 500 above their 200-day moving average and above their 50-day. In terms of compared to their 200-day, 66%, not a bad reading. Stocks above their 50-day, 69, almost 70%. So we've seen a steady improvement in these indicators since they were fairly weak around Thanksgiving, right? Fourth week in November, third week in November, these are pretty low, right? We got down to around 32% of stocks above their 50-day moving average. That's up to 70%, right? Which means about 35% of the S&P were below their 50-day or third week in November and are now above. And that tells you what a bounce we've experienced. And it's not just a small number of companies doing that. It's a lot of companies that are improving. The long-term breadth has been bullish really since May. To be honest with you, because we've had over half of the stocks in the S&P above their 200-day. It's the short-term breadth that looked really questionable in October and November. And again, totally agree with the idea that the breadth has been positive, remains positive, and more days like today just continue to make those breadth readings pretty strong. Thursday is when a lot of the weekly sentiment data that we track is updated. So I just want to take a moment checking on some of those. We're at 43% bulls in the AAII survey. That is up just slightly from where we were last week. 30% bears, which is actually up slightly from where we were last week. The spread between the two is still very much on the bullish side, about a 13% spread between bulls versus bears. So that's a strong bullish reading, but not excessive. On the name exposure index, it wasn't updated on stock charts when I checked earlier today. Last week, it was around 93%. Today, it got up to around 97, 98%. Hopefully, they get that fixed here very, very soon. But anything above 100% is a warning sign for me. That's a contrarian sell signal because it tells me that there's too much bullishness with this group of money managers that report in this survey. So name exposure index getting very close to that leveraged long zone above 100%. Bitcoin has simply been quite incredibly choppy. It was pretty encouraging over the weekend and going through Monday's session as Bitcoin pushed above 94,000 for the first time really since December, really November was the last time it was well above that level. For now, though, we've stalled out there. We've pulled back from almost reaching 95,000. We pulled back to around 89,000 and change. We're currently just back above 90,000 as we go live with the show, just above 91,000. And so, Bitcoin's sort of settling into the range that we've been in for the last 8 weeks or so, 6 to 8 weeks. Break above 94,000, it's pretty bullish. We talked about that as a way of clearing that December peak. Currently, we have broken above the 50-day. We're pulling back to test that from above. I wonder if that's a place where we have a short-term, low before the next leg higher. But if we break much below current levels, I think that unlocks a retest of those previous lows and maybe weaker momentum as well. It's been awesome here at the CMT Association event in Tampa, reconnecting with some longtime former colleagues, friends, contacts in the industry, meeting some new people as well. I've already met a number of really fascinating investors from around the U.S., and it's a pleasure to do so. That's one of the great things about coming to a meeting like this is reconnecting with people that you know and meeting some people that you're glad you do. I was chatting with John Kalovis earlier. He is a former, he's current president of the CMT Association, one of my former analysts from Fidelity. I really enjoyed working with John. He's just a really a smart analyst with great process, great routines. A lot of my conversations with John sort of led me down that path of focusing on consistent routines as an important lesson for all sorts of investors. He actually was on a panel earlier today with Gina Martin Adams of, Gina, I forget your new firm. She was at Bloomberg Intelligence for a number of years, just left for a new wealth management firm. But talking with, in that panel, John talked about what he calls the IFS index. He said the three bellwether groups that he looks at are industrials, financials, and semiconductors. And all three of those are outperforming. And that was one of the reasons why he was saying conditions are pretty strong here. I'm showing here the relative performance of the industrial sector, the financial sector, and the semiconductor ETF, all versus the SPY. We can see since the end of November, the industrial sector has been outperforming. Since the end of October, the financial sector has been outperforming. And since mid-November, semiconductors have been outperforming as well. I guess the corollary to that is as long as these sectors are outperforming, how bad could things be? If they stop outperforming, how bullish do you want to be? And that's what I would say is important and why I love coming up with this sort of pattern. I appreciate John sharing this idea with all of us. Important chart to follow just to look for when those relative performance trends change, because that would tell most likely of the next change in leadership. In terms of individual names, Amazon.com, I'm sure you've heard of this one, big weight in the consumer discretionary sector. One of the debates with peers here today is where you could appropriately bucket Amazon. Dave Lundgren, who I've known, Bostonian and fantastic technical analyst and money manager as well, basically has created his own industry groups because he doesn't like any of the pre-designed ones, and he buckets Amazon outside of consumer discretionary because it's just hard to bucket, right? It's more of a technology e-commerce kind of company. Having said that, the chart's improving. And if you look at Tuesday's breakout, that's after Monday was a nice uptick, right? This was last Friday. Here's Monday, back above the 50-day. There's Tuesday, Wednesday, and today, Thursday, we're closing back at the highs of the day. So while some of the Magnificent Seven are languishing, they're struggling, the NVIDIA, Broadcom, Apple, Microsoft charts, those big technology names, Amazon, which has really been a choppy sideways chart. And if anything, I mean, sort of it looks like a big topping pattern of some sort. We're now moving higher. We're breaking to new swing highs. We're making higher highs and higher lows. The previous all-time high around 257, 258. That's where I would be focusing in. I think clearing that level would be pretty bullish. But for now, I like the short-term rally on stronger momentum. And I think that's what impresses me the most. We've highlighted how some of the, disk drive companies, right? These storage companies, I probably should stop calling them the disk drive companies. That's an antiquated way of thinking of names like SanDisk. But old habits die hard, I guess. Western Digital, we'll call them storage companies. Western Digital, Seagate, STX, both just, I mean, incredible uptrends over the last, 8 or 9 months, coming off the April low, outperforming beautifully. I mean, really accelerating to the upside. Both pulling back today after pulling back yesterday. They're still good, right? So, I mean, if you think about, is Western Digital a broken chart? Absolutely not, right? I mean, I think the move that you've had is a 2-day counter trend move. I don't think you can label that as anything different because we're still making higher highs and higher lows, because we're still holding the 21-day EMA, because the moving averages are all in the proper order. Think of a chart as broken when the moving averages are no longer in the proper order, when these start crossing down, when the price starts breaking the 21-day and the 50-day. Get concerned when the momentum is no longer strong and in a consistent bullish range. Get nervous when it breaks into a bearish range. Get nervous when the stock starts to underperform. That's happened for 2 days, but 2 days is not a trend, folks. So we'll continue to watch those and see what happens. I sat next to my good friend Jay Woods earlier today, a CNBC contributor, longtime NYSE executive floor governor, and a genuinely fun guy to hang out with. Jay showed me the chart of home builders, talked about the bounce today. It's interesting when you think about rates going higher today. That generally tells me home builders are not a good play, because higher rates mean more expensive homes, mortgages are more expensive, that kind of thing. But if you look kind of this bullish outside day on the chart of the XHB and the ITB are the two big home builder ETFs. They're similar, but their weightings are a little bit different. XHB is one we're highlighting here because this bullish outside day, which is when you have a down day and then an up day, where day two's range engulfs day one's. If you're a candlestick person, this is a bullish engulfing pattern, but it happens right at the 200-day moving average. And I think that means something, right? This bullish short-term rotation at a key level of support, that tells you that traders are buying into the weakness from yesterday into today's open, buying today's open and pushing the price higher. So still more to prove. I think a push above 110 would make the XHB look like a much more impressive uptrend, but something to look at. Jay and I were also talking briefly about aerospace and defense, ticker ITA. You almost have a weird bearish engulfing pattern yesterday. Earlier today, I mean, just a little bit before the close, today's trading was down here, so it almost looked like a bearish engulfing pattern. It was like a double down on the bearish engulfing pattern with another higher open and another lower close. Didn't quite get below yesterday's close, but this is the bearish engulfing pattern. And today, with that big sort of sell-off after the higher open, certainly gives you the sense that for another day, you're getting investors, getting traders selling into the strength of the open. It did have a pretty volatile session, pretty wide range today. So certainly volatility you want to be aware of. Again, whether or not you agree with some of Cathie Wood's takes, and I agreed with some of it, the promise of the technology, undeniably fascinating. I would say I disagree with some of her takes on the reasons to be completely bullish on all things AI here, and the idea that these companies are all going to make are already making tons of money was what the presentation was. I don't know about that. I would say, not a ton of profits. I would say there's a lot of heavy borrowing for AI infrastructure, but regardless of whether you agree or not, she did mention some of the other ARK funds. We talked about the autonomous technology and robotics ETF, ARKQ. We also talked about the space one. I think that's ARKX. I want to say the space exploration ETF. Both of those making new all-time highs here. ARKQ finally breaking above resistance here around 125. I think it's an interesting chart because look at the classic bearish divergence there in October. This is when we make new highs in price, lower peaks in momentum. Ended up being a great sign of an overextended market due for a pretty decent pullback. Had about a 3-week drop into a low in November, right around $100 a share on that ETF, and that was the low. I mean, great reminder on paying attention to big round numbers, because you often ends up being a pivot point. Great reminder to just follow the trend. So higher highs, higher lows, just today breaking up. Today was a bit of a shooting star candle with the open and close near the lows. Long upper shadow might be the next 1 to 2 bars, maybe a bit lower, but overall a breakout worth highlighting. Finally, energy having a pretty decent day here. Not all of those charts look particularly strong. However, I want to celebrate the ones that do, right? If you're struggling within a sector like energy, what's the play here? For me, I like looking at the strongest charts. If you think energy is a great play, find the stronger charts in energy. Those are the ones that have generally, pointed me in the right direction. Halliburton's been in a pretty good uptrend off of the April lows. It hasn't been outperforming much, right? And if you look from May through October, it was really more in line with the market. But look at the relative performance in the last couple months. Look at the fact that we're now making clear higher highs and higher lows. Look at these pullbacks to moving average support. Now, more recently, we've had this nice break higher. We had this gap above resistance around 29.50, 29.70. We gapped up to around 33 the last couple sessions, pulling back, but holding that range. I think that $30 level ends up being a bit of a pivot point as well. Holding there, and today's rally sort of gives you the sense that maybe this is the next higher low within a new uptrend phase. Again, I would argue that charts like Halliburton, it's not about predicting the future. It's more about defining the trend, which I would say is constructive here, following that trend as long as possible, and just defining your stop, right? What would tell you that uptrend is no longer in play? And as long as a chart like this keeps making higher highs and higher lows, I would say the trend is positive. Folks, that will do it for today. Thanks so much for tuning into the show. Thanks again for flexibility as I get to the show as soon as I can. It was either that or cancel the show for the week. And I thought this would be an important week to share some ideas with you. And I hope you are okay with the different kickoff time. But I appreciate very much you tuning in. Thanks so much for sharing the show with others, for mentioning that you watch it. Appreciate it. Thanks so much for putting a comment on our YouTube channel with any questions that come up. Planning an all mailbag episode tomorrow on Friday, January 9th. We'll be traveling back to Seattle on Saturday morning, planning a normal publishing schedule next week, the week of January 12th. By the way, we'll be doing our 2026 market outlook on Thursday, January 15th. We're planning that at 11 a.m. Eastern, 8 a.m. Pacific. This will be a live webcast, but only for Market Misbehavior Premium members. My premium membership is a way to help a smaller subset of my followers to really think about their process, to make meaningful changes into how they're making decisions. And we do that through virtual courses to teach you all about technical analysis tools and techniques. We do that through member-only reports where we focus on investing ideas and focus on long-term and short-term trend analysis. And then we focus, the third benefit is a live community, a member community where you can ask questions at any point. I'm in there every day answering questions. We'd love to have one more premium member. You can learn more and also participate in next week's 2026 Market Outlook by going to marketmisbehavior.com/premium. Don't forget to use the code YouTube when you check out for 30% off your first 12 months on any plan. That'll do it from kind of dark, but generally sunny Tampa, Florida here today. Thanks for tuning in. I'm Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts. Have a good night, folks.